3 months is a long time in investment markets, as you know. Hell, a week is a long time in investment markets. Back in April, we discussed what was happening in global markets and how bearish you were and potentially the whole investment committee was. And since then, things have kind of gone in the opposite direction to what we've expected. Markets have gone up, investment markets have gone up rather than down. So the question I pose to you is, in light of that, are you still bearish? And what do you think is going to happen over the next 3-6 months?
Well, thank you, Eugene, and it's great to get the opportunity of sharing my thoughts on the world. As you absolutely correctly identified, the last time I presented in this format, I was negative, I was bearish. If you recall, Eugene, we'd just come through the beginning of the regional banking crisis in the United States, and we'd seen the spectacular failure of Silicon Valley Bank, followed by a few others thereafter. And I took that as a sign that things were beginning to, kind of break and fall apart in the United States. I'm afraid, of course, as we now know, 3 months later, the US central bank injected $400 billion of liquidity into the system. And then, of course, we had that dramatic event in May, if you recall, Eugene, when NVIDIA announced the largest upward revision or upward guidance to revenue that we've ever seen from a major company pretty much in US stock market history. And obviously, that also centered the market's opinion or perspective around artificial intelligence. So yes, since we last spoke, equity markets, particularly in the United States, have in fact performed pretty well. You then asked me the question, am I still negative? Am I still bearish? I am. I'm afraid I am. I am still bearish. And the reason for that is because, of course, price earnings multiples in the United States have expanded quite significantly. And what is also noteworthy is we're just coming to the end of the second quarter earnings season, reporting season in the United States. And when all is said and done, we've still got a few more reports to come through. EPS, or earnings per share, for second quarter 2023 is going to be around about a -5%, -6% year on year. So what we've seen, Eugene, in the last 3 months is that, yes, the US stock market has gone up, particularly the NASDAQ, of course, which that has been driven by an expansion in price earnings multiples, not by an expansion in earnings per share per se. It's been driven by price earnings multiple expansion. And that concerns me somewhat, because I'm still of the view that the global economy is really beginning to slow down a bit. And we can explore that further, obviously.
JP, so in layperson's terms, what you're saying, if I understood you correctly, is share prices have gone up, not because companies have reported better profits, but because investors have been prepared to pay a higher multiple for those profits that are there. Is that a fair
that is
summary
fair.
of what you said? Yeah. Okay.
Yeah, that I would agree with that, because of course what we've seen is price earnings multiples now rising to 20 and 21 times for trailing EPS. So that's quite a high price earnings multiple. And I continue to be of the view that I understand that the recession hasn't arrived yet. And Eugene, you and I have had many conversations over many months about this. But at the end of the day, monetary policy acts with long and variable lags, and it's not instantaneous. Economies don't go into recession a week or a month or even 3 months or 6 months after a rise in interest rates. It takes time for behavior to change. And so the other thing I just want to say to everyone is that I have acknowledged, and for people who read my weekly pain report, which is obviously weekly, I write it on a Saturday, I have acknowledged that the US household or US consumer has been somewhat insensitive to the rise in short-term interest rates. Why is that? Because US households are almost unique in the world because they can take out 30-year fixed rate mortgages. And we can see that many households in the United States basically refinanced when mortgage rates in the United States in 2020 and 2021 were very low. So we've got ample evidence that people were fortunate enough to lock in 30-year mortgages at kind of 2.5%, 3%, perhaps 3.5%. So the rise in short-term interest rates, obviously engineered by the US Central Bank, hasn't really impacted people with mortgages the way in which it is impacting, obviously, households here in Australia and obviously, for example, in the United Kingdom. So I've had to acknowledge that there is a greater insensitivity to higher short-term interest rates on the part of much of the US household sector because of that 30-year fixed rate phenomenon. So I have written about that in my reports as one way, I suppose, of trying to provide an excuse for not having sufficiently paid enough attention to that element of the American economic jigsaw puzzle.
Yeah, fair enough. I guess it is an important point, and it's a way that the US, I guess, housing market and interest rate market has a different impact on the consumer compared to Australia, where the vast majority of loans are variable or have very short fixed term periods.